in the case of the gold-silver ratio, that the market can stay irrational longer than we can all stay solvent. And that's really very true. Today is a good example. I mean, the market has been unbelievably volatile today.
I come to the conclusion that leasing is coming to an end, and that is withdrawing huge quantities of bullion, physical bullion, from the market. And the consequences will be seen in the paper markets because they will contract on the back of it.
Wherever the supply is going, there's a fire and they got to put it out. What was the number? 300, 400, 500 tons have been onshored over the last 4 to 6 weeks. And now all of a sudden, first notice day, there's 333 tons standing for delivery. That's your answer.
This week, 3 well-known voices in the financial space, Alasdair Macleod, Bill Holter, and Andy Schectman, shared their insights on the latest developments in the gold and silver markets. We've gone through hours of content to bring you the most important highlights, so you don't have to. It's been a turbulent few days across the board. Gold has broken into new record territory. Silver experienced a sharp drop, and the S&P 500 took a major hit. Volatility is reaching extreme levels, and we're here to unpack what it all means. We'll also take a closer look at the 2 biggest stories making waves in the financial world right now, and how they connect to the future of gold, silver, and the global economic outlook. If you haven't already, hit that subscribe button, turn on notifications, and share this with anyone who's into precious metals.
Gold was down $80 at one point, and about an hour ago it was actually up for the day, and now it's down about $27. So, you know, when you talk about this whipsawing, yet only giving back less than 1% on gold isn't the case right now with silver, which is down $2 to right at $32 or just above. Certainly and I guess if I had to summarize it, to me, it's almost like there's a clear effort to flush the managed money out of their long silver positions on COMEX. And maybe it's to allow these commercial banks to cover at lower prices. I don't know, but certainly today was one heck of a volatile day, not just for precious metals. I mean, look at the markets themselves. The Russell 2000 index officially has entered bear market territory for the first time since 2022, and NASDAQ down almost 6%. And, you know, the markets are getting clubbed. And then you have Secretary Bessent saying, yeah, that, the collapse of the market is not a MAGA problem. It's the MAG 7 problem. And we talked about last week on your show that the MAG 7, when you talk about the hedge funds having their lowest allocation to the MAG 7 in over 2 years, you know, things are certainly starting to get very interesting, as they say, which of course is the Chinese curse. When you live in interesting times, these are not for the faint of heart, for sure. Well, let's not forget about the dollar, which has lost 35% of its purchasing power against gold in less than a year. And so it's not just the volatility we see in silver, but the volatility in the dollar too. And that's the thing people need to remember, is that we're valuing everything against dollars, but gold's rise of 35% just since the beginning of the year would signal that the dollar has lost 35% of its value against gold in the last year. And now you have the Fed pricing in a 70% chance of rate cuts in June, and the yield on the 10-year falling. Again, you're looking at the potential of dollar weakness going even further and further and further. So, I mean, you make a very valid point, but I would also add to that this fiat system, as you mentioned, is beginning to show cracks. And it's you know, this global confidence that's underpinning the dollar's dominance seems to be wavering a bit, especially with what Trump is doing with the tariffs and what the markets are saying. And when you see the Russell 2000, which is the broadest measure basically of the economy, all the small caps, the businesses getting hammered, I think it's time to buckle up a little bit. I'm not making a statement on where I think gold and silver are going, but I'm just simply saying that the markets are telling you right here and right now that they're concerned about what's going to happen the rest of the year.
Silver fell hard on Friday, sliding to $31 per ounce, its lowest level since January 29th, and closing the week down more than 9%. The ongoing trade tensions continue to drag on market sentiment, with worries growing over a potential global slowdown. China announced that starting April 10 that it will introduce a 34% tariff on all U.S. imports, a direct response to the latest set of tariffs from the Trump administration. Earlier in the week, Trump implemented a 10% base tariff on all imported goods, with significantly higher rates hitting major economies, 54% on China, 20% on the EU, 24% on India, and 27% on India. Argentina also found itself on the list, facing a 10% duty under the MLA clause. Markets reacted sharply. Stocks and commodities were hit the hardest, while investors moved their money into traditional safe havens, like government bonds. Despite the overall market downturn, there's still a case to be made for silver and other precious metals staging a rebound. With recession risks growing, more traders are factoring in the likelihood of Federal Reserve rate cuts in the near term, which could offer renewed support for metals. Now we're bringing you the top moments from our latest interview. If you're not already subscribed, make sure to do that now and turn on notifications so you don't miss any of our upcoming updates.
But just understand, people for years have said, when's it going to happen? You're watching a failure to deliver happen. You're watching the nuts and bolts of that happen. I mean, think about this, Chris. If you go back 10 years ago, I would bet that there were not 300 or 400 tons for the whole year delivered. And you cannot print gold, you can't print silver. So if somebody's standing for delivery, and they don't accept a 20% profit bribe, they want the metal instead, this will end in a failure to deliver. That's going to happen. Is it immediate? Well, it looks like we're in the process of, just simply because of what's standing for delivery in both silver and gold, it's going to happen fairly soon. Yeah, otherwise you get a failure to deliver and then COMEX is done. I mean, the COMEX gold fails, COMEX silver fails, and what does that mean to all the other contracts outstanding? Like, corn, wheat, fuel oil, interest rates, et cetera, et cetera. If you prove two contracts to be completely, a complete fallacy where they can't deliver, my past partner, Jim Sinclair, used to pose the question, what is a contract worth if it cannot perform? And the answer is zero. And he posed the possibility of seeing COMEX gold at $10 an ounce offered, no buyers, and physical gold bid at $50,000 an ounce and no sellers. Also, you've got some people who believe that, and I'm sure have acted on it. So you've got some flow because of the tariff news, but I don't think tariffs are a real underlying reason to be onshoring, or for London, Switzerland to be sending, buku amount of gold to the United States. I think it's pretty obvious. In 300, 400, 500 tons have been onshored. You don't have to be a rocket scientist to put those two data points together. Russia's reserves were confiscated, stolen, whatever you want to talk about, or whatever you want to call it. From that day forward, gold has done nothing but go higher. And that makes sense because foreigners look at Russia having, what was the number, $300 billion sequestered. And foreigners are saying, well, hey, if they can do it to Russia, they can do it to us. And what that's done is it's mobilized foreign sovereign treasuries, foreign central banks to offload treasuries, and they're buying gold with it. And you mentioned another 45,000 contracts. If you look at the volume for the day, I think it was a very low number, like 7,500 contracts or something like that traded. So if that's what traded, then how did they open 45,000 new contracts?
Silver fell hard on Friday, sliding to $31 per ounce, its lowest level since January 29th, and closing the week down more than 9%. The ongoing trade tensions continue to drag on market sentiment, with worries growing over a potential global slowdown. China announced that starting April 10 that it will introduce a 34% tariff on all U.S. imports, a direct response to the latest set of tariffs from the Trump administration. Earlier in the week, Trump implemented a 10% base tariff on all imported goods, with significantly higher rates hitting major economies: 54% on China, 20% on the EU, 24% on India, and 27% on India. Argentina also found itself on the list, facing a 10% duty under the MLA clause. Markets reacted sharply. Stocks and commodities were hit the hardest, while investors moved their money into traditional safe havens, like government bonds. Despite the overall market downturn, there's still a case to be made for silver and other precious metals staging a rebound. With recession risks growing, more traders are factoring in the likelihood of Federal Reserve rate cuts in the near term, which could offer renewed support for metals. Now we're bringing you the top moments from our latest interview. If you're not already subscribed, make sure to do that now and turn on notifications so you don't miss any of our upcoming updates.
The movements in the past going into the back entrance of the Bank of England. In fact, I used to lunch with the head of the foreign exchange department occasionally in the Bank of England. And we used to see these trucks going in. I mean, I think it was really 2 days a week. You get about 5 or 6 trucks going in and out and all the rest of it. And you'd never know what they were actually carrying. But there is a logistical problem. The other thing I would say, Andy, is that I don't really regard the Bank of England vault as a major storage point for commercial entities. It's basically for central banks. So if commercial entities are taking gold out of the vaults, then I'm fairly certain that this is going to be leased gold. Now, this is important because I think if you look at the leasing operation, leasing, swap, whatever, if you look at that, Frank Venerosa wrote about this back in the late 90s, and also he spoke particularly at, I think it was 2002 in Lima, where he concluded that possibly between 10 and 16,000 tons, and that's between a third and a half of all central bank gold, was out on lease at that time. And as he put it, was adorning the necks of Asian women. In other words, it had gone into the market and wasn't going to come back. So there is this problem, I think. Now, I think that following that, basically the way the Bank of England worked it was book entry transfer. In other words, we can arrange for gold to be leased to you as a commercial entity. But it remains in the Bank of England vault because it's got to remain in a vault somewhere. If you're using it, let's say for collateral or whatever it might be, then there's no need for it to move out of the vault. So this becomes what they call a book entry transfer. So in other words, you instead of having the stuff delivered into the market and disappearing, you had 2 owners, if you like, of the gold in the Bank of England's vault. So it didn't appear that there was a problem. I think the importance of this development recently is that this gold is now being arbitraged out of the Bank of England vault and into COMEX. The other side of the COMEX problem, I think, is the stands for deliveries. Now, I don't know who the hell's standing for delivery, but I'm pretty sure it's not swaps, it's not bullion bank trading desks or whatever. I mean, because apart from anything else, you had the situation which has forced a huge great premium on the futures, which has created this arbitrage in the first place. If it was just a matter of the establishment swapping chairs on the Titanic, you wouldn't get the premiums on COMEX. The reason that this stand for delivery, I think, is so important, and nobody seems to be mentioning it, is that if you work out the stands of delivery over the last 4 years, up until the end of last year, it was around about 2,000 tons, 2,100 tons, something like that. That is a huge amount of gold. But since the 1st of January, those stands for deliveries have accelerated at a rate whereby if that's maintained, it would be something like 1,700 to 2,000 tons this year alone. In other words, the pace of stands for deliveries has accelerated very, very sharply. Now, undoubtedly, this might have something to do with, Trump. Basically, you stand for delivery if you want gold and you don't want dollars. Really what you're doing is you're selling dollars and you're buying gold. But as we know, if you stand for delivery, you don't necessarily get delivery. That is something that sort of you have to keep on badgering to actually get. Now, put yourself in the shoes of, if you like, the establishment, if you like, which is faced with all these liabilities discharged. Because legally they should deliver a stand for delivery, so they can't ignore it. And they have the problem that if we get tariffs, then my goodness, we don't have enough gold to match this. So they had to create this enormous flood of gold into COMEX warehouses in order to cover those stands for deliveries. And I think that's basically what's happened. But the interesting thing, Andy, is look at the phases. First of all, the one that
Now we're bringing you the top moments from our latest interview. If you're not already subscribed, make sure to do that now and turn on notifications so you don't miss any of our upcoming updates.